CeFi or DeFi? Is global finance going to be reconstructed or deconstructed? Can you imagine the future of finance without banks or other middlemen? Hi, and welcome to Crypto Market, where we cover all topics related to cryptocurrencies. To understand decentralized finance and how it works, let's look at centralized finance, CeFi, and know how it differs from DeFi. In centralized finance, your money is held by banks, corporations whose overarching goal is to make money. The financial system is full of third parties who facilitate money movement between parties, with each one charging fees for using their services. For example, you purchase a gallon of milk using your credit card. The charge goes from the merchant to an acquiring bank, which forwards the card details to the credit card network. The network clears the charge and requests a payment from your bank. Your bank approves the charge and sends the approval to the network through the acquiring bank back to the merchant. Each entity in the chain receives payment for its services, generally because merchants must pay for your ability to use credit and debit cards. Direct purchases aren't the only type of transaction or contract overseen by big companies. Financial applications such as loans, insurance, crowdfunding, derivatives, betting, and more are also in their control. As a result, there are few ways for consumers to access capital and financial services directly. They cannot bypass middlemen like banks, exchanges, and lenders who earn a percentage of every financial and banking transaction as profit. DeFi, short for Decentralized Finance, challenges the centralized financial system by peer-to-peer payments enabled by Ethereum, Avalanche, Solana, Cardano, and other Layer 1 blockchain protocols. Via blockchain, DeFi allows trustless banking, sidestepping traditional financial middlemen such as banks or brokers. Watch our video about blockchain if you're unfamiliar with it. When you make a transaction in your conventional checking account, it's recorded in a private ledger, your banking transaction history, which is owned and managed by a large financial institution. DeFi creates new infrastructure to deliver similar financial products and services with using blockchain technology and smart contracts, among other tools. Due to the distributed blockchain feature, all parties using a DeFi application have an identical copy of the public ledger, which records each and every transaction in encrypted code. That secures the system by providing users with anonymity plus verification of payments and a record of asset ownership that's impossible to alter by fraudulent activity. Think of it as a running record of all transactions on that specific blockchain chronologically recorded. If person A pays money to person B, that would be time-stamped permanently in the ledger. To enable DeFi, smart contracts automatically execute transactions among participants. When the contract's conditions are fulfilled, they self-execute their set of instructions. What are smart contracts and what is their role in DeFi? Smart contracts form the backbone of any DeFi protocol. By default, smart contracts are open source. If you have no idea what smart contract is, you should definitely watch our video on it. The vast majority of blockchain networks and smart contract-based apps are organized as decentralized autonomous organizations. DAOs are internet-native organizations collectively owned and managed by their members with no central leadership. Decisions get made from the bottom up, governed by a community organized around a specific set of rules enforced on a blockchain. The relationship between DAOs and DeFi is symbiotic. Without DAOs, DeFi would lose a huge number of users. And without DeFi, DAOs would have a much harder time coordinating their members' finances and funneling them toward the group's mission. To know more about DAO, watch our video about it. DeFi has opened up multiple avenues of income for investors. Yield farming is such investment strategy in DeFi. It is a way to generate rewards with cryptocurrency holdings. In simple terms, it means locking up cryptocurrency and getting rewards. But how does it work? Users providing their cryptocurrencies for functioning of DeFi platform are known as liquidity providers. These LPs provide coins or token to a liquidity pool, smart contract-based decentralized application that contains all the funds. Once the LPs lock token into a liquidity fund, they are awarded a fee or interest generated from the underlying DeFi platform that the liquidity pool is on. With all the advantages, DeFi also has its risks, including regulatory risks because the reach of DeFi is global. Peer-to-peer transactions are generally anonymous and there are no identified intermediaries. Here, two topics are particularly important for the regulator: the fight against money laundering and terrorist financing on the one hand, and consumer protection on the other. The non-paid survey, Prime on DeFi Risks and Regulations, provided by Fitch Ratings, described DeFi vulnerable to cybercrime, scams, and market manipulation. Researchers reported more than $7.7 billion of digital assets were stolen by cybercriminals last year. China has essentially banned the use of DeFi and private digital assets, and Russia is debating whether to take a similar approach. Still, the survey said many countries are expected to view DeFi more favorably, allowing it to evolve, but with more regulation.